Well, momentum players and index investors, beware. My next guest says it is a stock picker's market. He manages $3 billion at Legg Mason Capital Management, and one of his funds is up 60% in just the last year, handily beating the S&P. Robert Hagstrom back with us. Robert, good to see you again.
Betty, good to see you.
Okay, so what would convince you? Because I was reading through your report, your recent report about a sideways market. You're still not sure that we're exactly in it, right?
Yeah, let me start by saying at Legg Mason Capital Management, we're reasonably constructive on the market this year. We would think the market could be up 10 to 15%. We're up already 3%, so another 10% from here would not be a surprise for us. But we wrote the sideways market piece because we just wanted to give investors a chance to think about if a sideways market were to occur, what could they expect?
Right, but does that mean that what more evidence do you need to show that we are, in fact, in a period like we saw, as you said in the report, 1975 to 1982, when we were, in fact, in a sideways market?
Yeah. Well, there were several things that happened in 75 to 82. One is that we had very, very mediocre real economic growth in corporate profits. That was one. Two was a rise in inflation and a rise in interest rates, and that caused the multiples to compress. That's basically the recipe for a sideways market. Thus far, Betty, we don't have that.
Yeah, we don't.
But that would be what would, that would cause a sideways market.
Robert, it's John Erlichman. Yesterday, Mike Hall at Paul & Company joined us here and said, if you were spooked right now, go for some of the multinationals in the technology space, names like Microsoft, IBM, Intel, that look cheap versus the rest of the market. What do you think of those names?
Yeah, I couldn't agree more. My position being a growth manager is that the high-quality, big-cap side of the market looks to me as about cheap as I've seen it since 1995. So I would agree with that wholeheartedly. High-quality, big-cap multinationals, we think, are positioned to be the new leadership in the market.
Hey, Robert, Adam Johnson, let me jump in here. Cash flow, is that really what it boils down to for you? Focus on cash flow, that's where you get the growth?
Well, that's probably, if you were to say to me, what is the single most important variable, both in how you think about valuation and how you think about growth, we're going to go for cash flow. That's the moniker that we want to see. And what we see in cash flow, particularly in technology and healthcare, other areas, that we're at record levels on free cash flow yield, which tells us that on an absolute basis, stocks are very, very cheap right here.
But small caps, you say they're not cheap.
Yeah, it's hard for me to get excited about the small cap stocks. If you look at the Russell 2000, I think the trailing 12-month PE is somewhere around 50 times. Some have suggested maybe earnings up 50% this year. That's reasonable, but that would still get you a multiple of around 35 times earnings for this year's earnings. That seems to be a little steep for me, particularly when you compare it to the S&P 500. Which if they reach $80, which I think is doable, we're probably more like 14 times earnings. So small cap stocks have done tremendously well over the last 12 months.
Right.
Big cap has not. I think it's time for leadership change.